So out of these four or five instruments, I think gold is the first one. So let's first understand how the gold functions. With gold, everybody suggests it's the best investment. So is it really true? So let's figure it out. The chart below shows you 1 year of data how the gold prices have been fluctuating. I'm sure you must have gotten an SMS from somebody or from your family that would have told you that gold, if you would have invested, you have yielded millions of rupees. That's not true. And let me tell you how. In the last 1 year, if I'm talking about April 2020 till April 2021, the actual return of gold has been almost 3%. And if I talk about the gold prices, then gold prices have gone up from 46,000 to almost 47,000. Someone might argue that gold prices were actually shooting up to the highest levels, and it was August time frame. And I'm looking at the daily prices. You can look at when in your cities the prices won't be very different from here. But yes, truth be told, gold has only returned almost 3% of return into the last year. And yes, gold is considered to be a safe haven for parking their money when the times are uncertain. It was Corona back then. That's why the gold prices were lowest at then, and that's why if you consider this peak, the return seems to be very high. But yes, since this is just the 1 year of data, and someone might argue that this is very misleading, this is not true. So we are also taking the compounded annual growth for the last 5 years, which is almost 12% for gold. Let's go ahead to the next vehicle. After gold, next interesting thing to see is stocks. With stocks, most of the people in India believe they are very risky. You shouldn't invest your money into stock, else you are going to lose it out. To understand it, let's first logically see what the chart tells us. To simplify things, I'm taking the top 50 companies or the index fund, which is also called Nifty 50, in which you can see that in April it was also facing its lowest time frame. When times go uncertain, then of course people start to move away their money to their safe havens like gold or some other investment that they believe to be more safer. So that's why at those times you'll find the stocks to be trading at the lowest level. But after that, even after when things have changed, or probably we have evolved to be into the better situation, it is showing you a consistent upside drive. So of course throughout the whole year the stocks have been growing, unlike gold where you have seen peaks and troughs. The overall return, if you compare it from the 9,000 level that were at the level of April 2020, in April 2021 the level is close to 14,000, so which is giving you almost a 65% return. Again, what we have done for gold, 1 year might be very misleading, but truth be told, the returns are even higher for the last particular year when you will be getting the WhatsApp messages, and again they will take you back for years. I'm not going to the 40 years or 30 years of criteria, because stock market will again going to beat gold out of the window. So truth be told, ROI for the last year was almost 65%. But yes, if you talk about the compounded annual growth for last 5 years, then it is almost 15%, which is still better than the gold. Let's move on to the next one. In the next line we have property. For property, it's very complex math, and you can create multiple videos to understand how property market actually works and how you should consider the return from it. And there are different ways to look at it. But just to keep things apple to apple, I'm still taking the stock market REIT as an example or as a benchmark to help us understand the property performance. And again, if I look at this particular market, and this is the chart for Embassy Office Park REIT stock price. Why stock price? Why not something else? See, whatever you are going to analyze, there can be some or the other difference that somebody can come and say that this is not exactly apple to apple comparison, but directionally it will tell us, and directionally we are not going to be way off from what you have seen the return into the property side of things. So first thing first, if I look at the stock price, it was on a higher side earlier in April 2020. If I look at the year end April 2021, then it is on a lower side. But again, the return is almost 345 to 314 is a negative 10% return. But somebody come and say that if I would have sold at this price level or that price level, friends, let's not argue into that. Let's take a 5 years average and let's find out after 5 years what has been your return. Then again, it is going to be a number which is close to 10%, not more than that. So we'll look about that for after 5 years of CAGR for all the different instrument vehicles in a summary later on. Let's move on to the next one in our list. Next one in our list is almost mutual fund. So mutual fund, again, there are different ways to invest into mutual fund, and there are different plans you can go ahead with. I am taking a direct plan in this case, which basically further enhances your capability to yield a higher return. So I'm taking the maximum return there. And let's assume if you have invested 1,000 rupees month on month, you would have invested almost 12,000 at the end of the year, and your return will calculate it two ways. One, we are going to calculate it based on, as you can see into the chart, I'm taking UTI Nifty Index Fund, and we are going to analyze it two way. First, we are going to look at the absolute return it has provided at the end of the year. So in April 2021, right now what we see, the return is almost 27%. So if you would have invested almost 12,000 bucks, then it would have yielded you another 27% on top of it, and which is going to be almost 3,600. But if I look at the analyzed return, they are going to be even higher, because it is going into consideration the time frame, the amount of money was invested. So let's say first year it was only 1,000 bucks, then 11 months it was going to be 1,000 bucks, and so on and so forth. So that's why your analyzed return is only going to give you a yearly picture. But to keep things on an interesting level, we are taking the return on investment to be 27% at this date in terms of absolute, and to make apple to apple, we are taking the 5-year average or CAGR, which is basically coming close to 12% in case of mutual fund. Next is the bank FDs. Bank FDs is the most reliable phenomena that people use in India the very most. You talk about post office schemes, which are more popular into the rural areas, or you talk about the bank FDs for senior citizens. They rely on them for their highest, for their assured returns as well as the zero risk. Ideally speaking, bank FDs are also not completely out of risk, but again, these are basically the hedge that people want to keep against their riskier investments. So definitely a way to go. But if I talk about return, in last 1 year, the FD returns have actually fallen down. If you go ahead and do a FD today, you are not going to get an interest rate higher than 5.5%. But yes, in the last April you are getting a 6.7% interest rate. But since you are going to make investment decision, or Aman is going to make investment decision after this video, so we are taking the rate of interest for him to be close to what he's going to get right now into the market. And again, I'm considering these levels to be the highest on higher side. These are even going to be really low in terms of reality, if you have to speak. So we have all these investments evaluated for us. Now it's time for Aman to make the decision in terms of understanding what is the return on investment. So this table basically shows you, first row shows you the 1 year return, and if you look at the 1 year return, these are very misleading numbers. Property is on the negative side, stocks is very much on the positive side. So to keep things on apple to apple and on a parity level and sensible levels, we have taken a 5-year average for all of these. So to speak about the winners in this case, the rank 1 goes to the stock market or the stocks, and in this case I have taken Nifty 50. All the resources and the description will have all the links to the sources of information where I have taken all of this information. This is pretty much into public domain, so you can always go back and check this information. So after stocks, it is going to mutual funds, which is close to 15%, but in points it is going to be slightly lower than the stock market. And yes, gold is going to be 12%, followed by property at a 10% on an average, and then you have bank FDs, which is still I'm taking on a higher side to be 7%. But yes, if I talk about purely from the investing point of view, Aman should ideally go ahead with stocks and mutual fund as priority 1 and 2. And if you really want to diversify, you should go ahead with gold. Property and FDs are still the ones which are going to pull down his portfolio, but he is really interested into diversify his portfolio, which I think at this point of time he is really not needing, because he can go more aggressively. He do not have too much of expenses or liability at his end, so he can pretty much go ahead and take this aggressive route so that he can develop his portfolio pretty fast. So let's understand and let's answer his key questions. So the very first question Aman had was, how much should be his portfolio allocation? The very first question answer is over here. The stocks market should be investing into 60%, followed by the mutual fund, which should be investing 20%, followed by property and gold, which should also have almost 10% of allocation, but not more than overall 20%. So almost 80% of portfolio is going into stocks and mutual funds. And this is based on 3 phenomena. First, we have calculated the rank, which is based on the return on investment. Second is the principal loss risk function, which basically tells you how much risk is there on the principal that you are going to invest into. Since if you look at FDs, almost zero risk is there in if you invest your money into FDs versus the rate of return is going to be the slowest. So the investment recommended for Aman is almost zero because he's considered to be an aggressive investor, and there are no liabilities that are sitting on Aman's head. But if someone has a liability, probably after considering your contingency fund or emergency fund putting aside, you can definitely take this investment plan for an aggressive investment portfolio. So overall, this portfolio investment is going to be this if you split the almost 1 lakh amount of money, and this is going to yield you 14% year on year, and almost double of the money will be retrieved by Aman at the end of overall 5 years. So he's going to earn almost 1,70,000, in fact even more than that, because it will have a compound impact onto it. So for Aman, this is the recommendation coming out based on his age, his stage of career. For senior citizens or probably those people who are little into the later stage of their life, definitely the plan would change. Let us know into your comments if you think that you need us to create those plans as well. Thank you so much for watching this video.